So there's three key considerations when we look at lending to people, and those are your ability to repay, your willingness to repay, and the value of the property. Now, we'll take them one at a time, and we'll first talk about that ability to repay. The ability means you've got the money to do it. You've got the income to pay the mortgage loan. We're also going to look at your assets and your other debts. So let's start with income. Everything we do is based on your gross income, which of course is income before taxes come out. So that right there, you're going to get a raise because we're going to use that number as opposed to your take-home pay. When we do that, we turn it into a monthly income number. And the reason we do that is simply the mortgages are due monthly. You have to pay us monthly. So we want everything to kind of be equal. And you'll see this all come together in a moment. So first thing, if you're salaried or hourly paid, it's very easy. You work 40 hours a week, and we can figure out very easily what you make per week. And then from that, we can figure out what you make per month. There are a few other situations where, you don't work a 40-hour week. You work maybe on commissions. You might work more than 40 hours, less than 40 hours, but your income fluctuates. In that situation, commission salespeople, we're going to average your pay over the last 2 years. If you receive overtime, we're going to do the same thing. We're going to average your overtime over the last 2 years. And this average of 2 years would apply to other situations, not only overtime, but if you're a seasonal worker, if you just work in the summertime or just in the wintertime, you make a lot of money in the short season. We're going to average that over 12 months. A bonus, if you receive a bonus, we're going to simply divide that by 12 and make that monthly income. So everything income-wise becomes a monthly thing. All right, so the first part to figure out if your ability to repay the mortgage is we're going to figure out also on a monthly basis what the monthly mortgage payment will be. Now, a mortgage payment consists of principal interest that you're paying back on the loan, the real estate taxes on the property. So, if the taxes are, $6,000 a year, you divide 6,000 by 12, you get 500. It's again $500 a month. Same thing goes for homeowners insurance. If you're buying a condominium, there might be a condominium fee. So that becomes what's known as your housing expense. Again, that's principal and interest, taxes, and insurance, and possibly a condo fee. So we then are going to say, okay, we know what the housing expense is. As a percentage, how much is that of your gross monthly income? Ideally, we would like to see that expense not exceed 33% of your gross monthly income. There's a little bit of wiggle room in there, so don't worry if you're scribbling on a note and trying to figure this out. And we'll talk about the wiggle room down the road here in the presentation. So now we have your income. We also know the housing expense. The next item we have to look at is your total debt. So we're going to take what's the housing expense that we just figured out, and we're going to add to that any monthly debt that you have to pay, like loans. So we're looking at car loans, car leases, personal loans. We're looking for the minimum amount due on credit cards. If you had to pay alimony or child support, those are legally obligated. We don't care about your everyday bills. We don't care about your cell phone, your electric bill, your gas bill, your car insurance, your grocery bill. Those are household expenditures, and those will be absorbed by the rest of your income. But we do the same thing. We try to figure out that ratio or percentage of your income. We're going to first start with the number we figured out earlier, the principal, interest, tax, and insurance. We're going to add to that any debts that you have. And again, that's the car loans and leases and the credit card payments, etc. And that second ratio should not be more than about 43% of your gross income. And again, there's a little wiggle room in there, but those are the guidelines. So 33% for the housing expense, and then another 10% to bring it up to 43% for your total debt. Now, if you're in a situation where you have a lot of other debt, maybe you've got a couple car loans, some big student loans, monthly payments on those, a lot of credit card debt where you have a lot of minimum payments that you have to make, that could easily eat up, 15 or 20% of your income. But we're not going to go above that 43. So if you're in a situation where your other debt eats up 20% of your income, is only going to be 23% left to pay for the housing. So this is a great opportunity when you finish up here tonight, is to examine where you are, look at your budget and see if your spending is, maybe excessive. I don't want to use the word excessive, but is a little bit high for what we're trying to do. What we're trying to do is get you into a home. So that is really the ability to repay. If you have that, basically, do you have enough money to make the payments? And if you stay within those guidelines, the 33, 43, you'll still have enough money to do the things you like. I mean, that means in this day and age, I don't know if anybody's going to the movies or out to dinner or anything, but when we get back to normal, people like to do those things, and you certainly will be able to live comfortably at that level. And that's, we don't pick these numbers out of thin air. These are numbers that through the years have shown people can do this and live a very comfortable life. So the second key consideration that we'd like to talk about is the willingness to repay. And this is your credit. I'm just going to jump the slides ahead here. Sorry about that. I should have skipped one, but this is your credit and your credit reports. Have you made your payments on time? Have you disclosed all your debts to us, and so forth? But the ability really is your credit. So we get credit reports, we look at them. When I look at a credit report, I kind of look at it backwards. So I'm going to ask, did you make your payments in September? Now that it's October, how'd you do last month? And then, look back to August and July and June and so forth and so on. So the most recent months are the most important, starting right now, going backwards. And, if the last 2 years are pretty good, you should be in good shape. Credit reports reflect your payments over the last 7 years and accounts that have been open in the last 7 years. Even if you paid a loan off like 6.5 years ago, it should still be on your credit report. So there may be some late payments. A lot of people have them. We all run into a little snag now and again. And, don't let that stop you. When we look at it, we may ask you, what happened? There may be very logical explanation. If we see a period of time that payments weren't made, it could be that you were out of work. It could be, you were unable to work because of an injury or illness, that type of thing. But just, bring those things up with your loan officer when you're doing that, and we can work with those things. So the other part of this is credit scores. Now, you hear a lot about credit scores and how it affects your ability to get a loan, and what are they and what do they do? We use this score called a FICO score, and you could see it's FICO, which stands for the Fair Isaac Company, which developed this score system years ago. The scores range roughly between 300 and 850. So, at 300, your credit is very, very extremely bad. And at 850, it's very, very good. 740 and above gets the best rates. If you can think that it's a sliding scale, almost like an elementary school report card, you get an A, That would be the 740 and above. If you get up over 800, you get the A plus. Going the other direction, if you're down at 700, you might be a B student. If you start, it starts to fall down quickly after that. A lot of loans want a score of at least 660. There's probably a couple out there that will still do loans at 640 before they really, you'd have to go into what they call a subprime mortgage lender, which basically means you're paying a high rate of interest to get a loan. But again, this is the scoring number system. How it's developed and how it works, they kind of keep a mystery, but we have some ideas. It's based on your credit history. Obviously, do you pay your loan? The amount of money that you owe, and this is important on credit cards. They like to see that you owe very little on your credit cards. So we all have credit cards. They all have a credit limit, and they like to see that your credit use, that means the balance, is down under 30% or even less. So if you have a credit card, that's got a $3,000 credit limit, and you owe $2,800 or $2,900 on it, just under the limit, that's going to hurt your credit score. Whereas if you had that same credit card with a $3,000 limit and you only owed, $150 or $200 on it, and then you paid it off every month, they would like that a lot because it shows that you've got restraint on the use of credit and you've got a lot of available credit. It might sound crazy to a little bit, but it's the way the system works. The credit scoring system also looks at the length of history. So that means how long the account's been open. And if you have credit cards, especially credit cards, because like a car loan will get paid off after so many years. Credit cards tend to be open for a long period of time. So even if you have credit cards that you opened up, 6, 7, 8, 9, 10 years ago, and don't even use frequently, they're actually helping your credit score because it's available credit, and it's got a long-term history. If you do have cards in that category where you've got some credit cards that you don't use on a regular basis, I always suggest that maybe you could use them every once in a while to buy something very small. Think a pizza or a tank of gas or something that when the bill came in the next month, you'd be able to pay it in completion. The reason is they look at credit cards and they look at the date of the last use. So if you've got a credit card that gets used, somewhat frequently, that will keep that card active, and I think it will reflect fairly and best for you on the credit reports. So keep that in mind. Don't go wild. Don't go out and buy stuff saying Tim said to use your credit card. I said to use it on a small thing and to pay it back immediately. All right. The last thing on the credit scores is that they do look at the mix of types of accounts. So if you just have, credit cards that are being paid, they'll like you. But if you also had a car loan every, few years, they like that too. They like the mix. So if you've got student loans, car loans, I'm assuming because you're here tonight, you don't have mortgages yet. But when you get a mortgage, they'll like you even better because you'll have a big that you'll be able to build on that credit score. And the mortgages will help through time build up your credit all the way through. So just a couple tips on, I mentioned how to ruin your credit score is very often we'll go into a store and the cashier, when you're checking out, will ask you, oh, would you like to open a credit card today? Maybe we could save you $10 or 15% or whatever the deal of the day is. And you say, okay, I'll do that. And this was, as the holiday season approaches, this is very tempting for a lot of people. So you go to one store and you do that, and then you go down to the next store and the cashier offers a very similar deal. And you say, well, gee, I saved some money at the last place. I think I'll do it again here. So what you end up doing by the end of the day, you've opened up maybe 2 or 3 new credit card accounts, and that probably will hurt your credit score 75 to 100 points, just like that. Um, it's because you're opening up what they call a revolving line of credit, which is what a credit card is. It revolves, meaning you pay it and it's available again to use again. And there's no payment history. And not only did you open one, but you opened multiple on the same day. So just be careful with credit cards. Um, they can be dangerous. I know a lot of people have fallen into the credit card trap through the years. Uh, but if you use them responsibly and well, you should have no troubles. While I'm thinking of it, I'll say this because I tell everybody, if you do buy a house, you do apply for a mortgage loan, please, from the time you buy the house, make the offer on the house to the time you close on the mortgage down the road, don't open any new credit accounts. Don't be tempted to go to Jordan's Furniture and open up an account because they're giving you free 18 months of interest. And, the temptation is there when you buy a house because you probably want new furniture or more furniture to furnish the house. But please hold off on that stuff till you get into the property and the loan closes. The reason I say that is, we check credit when you first apply on the very first day when you apply for the loan, but we check your credit again a day or two prior to the closing. And if there's, new accounts, we want to know about them, and we can tell from the credit reports if they are new accounts, or even if you've had a credit inquiry. And you don't want to be in a situation where you were approved for a loan, and now that we updated your credit report because of new debt, you don't qualify for the loan. So be very careful. And when you're applying, you talk to myself or Chris or Joe or Tricia, and we can advise you on things like that. Sometimes you get stuck. You have to do that. I've had people who were in automobile accidents and had to get a new car in that time frame. And as long as we know and we can keep the payment roughly the same, we should be in pretty good shape. So that's it about credit scores. I know you don't have this slide pack with you tonight, but it will be going out to you. In here, there's the names and the websites for the various credit reporting agencies. There's a place you can check your credit report for free, which is annualcreditreport.com. And that is a free report that you can go in and get once a year. And that's one free report from each of the above credit agencies. For instance, you could go in there tonight, get all 3 reports, and then you could go in again a year from now and get them again. I always suggest maybe go in there and get one of them tonight, or whenever you do it. Wait a few months, and get the second one, and a few more months to get the third one. So you kind of rotate them throughout the year, so you get a pretty good idea of what's going on. The reports are not identical, so some of the credit card companies won't report to all 3 of the agencies, but it should give you a pretty good idea of what's going on with your credit. It's always a good idea to make sure there's no credit card frauds or identity theft or that type of thing. The last one on the slide, you can see it's myfico.com. That's a place where you can actually see your FICO score, but they do charge you for that. Now, a lot of credit card companies I know now are printing your credit scores right on your credit card statements. But you have to look at your statements. I know I'm guilty of the same, as I don't always look at my statement until it's the day it's due, or even then, sometimes I just do it electronically. So we just, if it is on your credit card statements, and I think Discover's doing it, I think Bank of America is doing it, and a couple of the other large credit card companies are doing it. It's a nice thing. You can see your score. So if your score changes drastically month to month, that's when you might want to check your credit report itself. And If you do that, you might see what caused it. Maybe you went to the mall and opened up a lot of credit cards, or, if it really drastic, it could trigger, or not trigger, but it might be a sign that there is a problem with identity theft. So always important to check. All right. Also, again, I'm not going to read all this stuff to you. Credit hacks. This is just a screen. How to protect yourself and protect your financial information. There's just some good links here to various websites, the Attorney General's office, the Federal Trade Commission, and so forth. So that, again, will be going out to you. So let's go now. Remember, way at the start, we had 3 key considerations, and that was your ability to repay and your willingness to repay. And the third one is the value of the property. And the value of the property is what you pay for the property. And, you come in to see us and you say, gee, I'm buying a house, for $400,000, whatever the number is. And what we do is we have an independent appraiser look at the property. They'll actually go out and visit the property with the real estate broker. And they're going to compare your property to 3 other properties that have recently sold. And they're going to determine from that, based on those recent sales, is yours worth what you're paying for it? They're looking at market value. The appraiser is not a home inspector. The home inspector is somebody that you're going to hire early on in the process. The appraisers are not home inspectors, the guys who inspect the pipes, the electric, the roof, and so forth. And we'll get this report. The report is probably stretches on for 20 pages or more these days. They get longer, it seems, every time I look at one. But it gives a lot of information. So like I say, it's going to compare your house to a similar house. Rarely will they be identical unless you're in a brand new subdivision or a brand new condominium complex. The properties, one might be in a little better shape than the other one, so they might make a value adjustment for that. Your house might have 3 bedrooms, the other one may have only 2 bedrooms, or, a bath and a half versus 2 baths, kind of things. One might have a deck, one might not, one might have a garage, one might not, one on-street parking, so on and so forth. But the value is established through the appraisal. I do want to touch on value in the event that the appraisal came in low. People always ask this question: what happens if it comes in low? So I'm going to use some easy numbers here so we can follow along. Let's say you were buying a house for $100,000 and you were planning on putting 10% down, or $10,000. You would then need a mortgage loan of $90,000. All right, so we send the appraiser out, and the appraiser comes back and he says, I think they've overpaid. In my opinion, the house is only worth $90,000. We say, okay, so first thing I'll do, I'll call you up and say, here's the appraisal. We've got an issue we have to resolve. Here are the possible resolutions. One, you can, and what most people do is try to renegotiate the price with the seller of the property. Sellers tend to renegotiate because they don't want to put the house back on the market and turn around and try to sell it again. It just takes up a lot of their time, and they may be having to close on another property. So they're very kind of dependent on everything going smoothly. So occasionally they'll say no, and you really want the house. So we will lend, in the original scenario, I was going to lend you $90,000, which would be 90% of the sales price. But now that we know the value is only $90,000, I'll still lend you 90%, but it's going to be 90% of 90,000, which, when you do the math, is only 81,000. So if you did not renegotiate, you'd still have to pay them 100,000, and I'm only going to lend you 81,000. So instead of a $10,000 down payment, all of a sudden you'd be facing a $19,000 payment. So that is a big, big difference. That is the end of those three key considerations. So let's talk about some stuff that you really came to know. And one of those things is, how much cash do I need? What are the cash requirements? So we've got single family homes available. Down payments ranging from 3% to 10% for single family homes and condominiums as minimums. Typically, the 3% down is going to be available on certain loans and only on single family homes and condominiums. If you're buying a two-family house, you're probably going to have a minimum of 5% down. And then if you're buying a 3 or 4 family, most likely you'll need more on the order of 10% down as a minimum. So you've got that. You're going to need money to cover your closing costs. Now, closing costs are the costs associated with the loan for things such as the appraisal, the attorneys, the title work. There's a lot of little fees. There are recording fees. We get a flood certification. We check with the IRS on some loans make sure your tax returns are correct. So just kind of ballpark figure, if you were to borrow $400,000, your closing costs would probably run roughly about $4,000. And it's funny, it just works out as a nice even number that way. If you borrowed $450,000, your closing costs would probably run more, maybe like $4,200. So it's a lot of the closing costs are fixed. They might be a little bit higher when you go into a multifamily home because the appraisals are a little more expensive on a multifamily home. For instance, the appraisals on a single family are typically $425 or $450, whereas the multifamily homes are typically $650 to $700. So not a big difference, but it does make a difference to you because it does increase the closing costs. All right, on top of your down payment and your closing costs, we like to see reserves that you have, a couple months of mortgage payments remaining after you're done. So that's a reserve that could be in your checking savings account. It could also be in your company-sponsored 401k plan or 403b plan if you have one of those. You don't have to take the money out of the retirement account, but we just want to see that you have that money available to you in case of dire emergency type of thing. Where do you get this money? Obviously, as I said, savings, checking accounts. If you have it there, it's fine. Inheritances. We've seen people receive money in inheritance, kind of a windfall, and all of a sudden they've got money for down payment. That is perfectly fine. If you're just coming into that money, we'd want some documentation from the executor of the estate, but that's pretty easily obtained and we can guide you through that process. Gifts of funds from family members. So if your parents, brother, sister, aunts, uncles, grandparents, etc., want to give you some money to help you buy a house, that's fine too. And we've got a form for that. A gift letter form is a very simple form, just says that the money is being given to you to purchase a property and it is a gift and not a loan. Sale of stocks, bonds, oddball assets are fine. I've had people come to me and sell antique cars, musical instruments. I had somebody who actually, go back to inheritances for a moment, somebody inherited some artwork from his grandfather. His grandfather was an artist and left all the grandchildren one piece of art. And this gentleman sold that art for a sizable amount of money and used that as a down payment. So if you do something a little funky like that, you want to keep the paperwork associated with it because you need to prove where the money came from. We're pretty good at tracking money in and out of checking and savings accounts. So if it's a recent transaction, we do look at that. If there are unexplained deposits in your checking savings accounts, we may ask about those. It's usually if it's more than half your monthly income, and it can't be explained as payroll or an ongoing payment coming to you, we would ask about that. So paperwork is very, very important. So that's kind of what you need, but I'm going to expand on that. We're going to talk about closing costs. As I said, that's the fees associated with the processing of the loan. So it's, as I said, the actual cost, all those things I was mentioning earlier, the attorney's fees and plot plans and title insurance and everything else. People ask about points, or you may heard the term points before. What are they, and what do they do for you, etc. Basically, a point is 1% of the loan amount, and you pay that. And if you do, you should get a lower interest rate. If you borrow $400,000, a point is equal to $4,000, which is 1% of that. If you do pay it, and it's optional, the rate, I would not do it unless the rate dropped by 1/4%. And at 1/4%, it will take you about 5 years to break even. So if you're buying a property and you don't think you're going to be there very long, you probably don't want to pay points. For a lot of first-time buyers, you don't want to pay points because that's $4,000 you could use elsewhere, maybe to buy that furniture that we talked about earlier. Just going on with the closing cost, the concept of prepaid interest on loans is you pay interest on your loan from the day of the closing, if you close mid-month, through the end of the month. The exception happens to be today. Today is the first of the month. And if you closed on your loan today, your first payment would be due November 1st, 1 month away. But if you closed tomorrow on the second day of the month, you'd have to pay 30 days of interest because there's 30 days remaining in the month of October. And then your first payment would not be due till December 1st. And that's kind of on a declining scale. So, if you fast forward here for the minute till, the 31st of October, which is a Saturday, so you wouldn't close there. But the 30th of October is a Friday. You could close on a Friday. If you closed on October 30th, you'd pay 2 days of interest for the 30th and 31st. So that would minimize your cost of this prepaid interest. This is why people will tell you often, gee, you should close at the end of the month, you'll save money. You think about it, it's kind of right, especially if you're paying rent now. Because if you just paid rent today, and you close on your loan tomorrow, I guess you wouldn't do that because of just a day, you could spend the night someplace else. But, if you closed in the middle of the month, say the 15th, if you paid rent on the first of the month, you paid for the whole month of October. And then, if you pay that prepaid interest for the 15 days remaining in the month, if you close mid-month, you're kind of double paying. There's nothing wrong with this to do it that way, as long as you know what you're doing. A lot of people want to close earlier in the month so they can get in, maybe spruce the place up, paint the walls, refinish the floors, that kind of stuff. So just trying to let you know these options are there. If you're tight on cash, this closing at the end of the month may be something you want to look more into. On top of all these other closing costs, you can see they're starting to add up now. We set up a real estate tax escrow account and possibly a homeowner's insurance escrow account. And those are accounts that, just what they say, for the real estate tax, we have to put enough money in an account to pay the next tax bill, and put a small reserve in there. So it could be anywhere from usually 3 to 5 months in most towns in Massachusetts that you'd have to put into your escrow account, depending on when you close and when the next tax bill is due. Homeowners insurance, you have to pay your homeowners insurance, which is the insurance, if the house burns down, if somebody slips on the ice and down the stairs kind of thing, you have to pay for the first year before the closing. And then on most loans, not all, but most of them, we will collect each month 1/12 of what the next year's premium is. So that in a year from now, we have enough money to pay the second year's premium, and on and on and on. So into that escrow account for the homeowner's insurance, we typically will take 2 months to get it started, because we have to pay that renewal policy, not exactly 1 year from now, but we have to pay it a bit in advance. The last item here is PMI, and we're going to talk about PMI. It's private mortgage insurance. It allows you to buy a house with a small down payment. I mentioned a small programs out there with 3%, 5% down, et cetera, et cetera. So if you have less than a 20% down payment, this will allow you to still buy a house. The cost of the mortgage insurance changes with the amount of down payment that you have. So it will change. If you put 3% down, it's going to be the most expensive. At 5%, it gets a little less expensive. 10%, it gets a little better. 15%, even nicer. And then at 20%, you don't even need this insurance. And then, of course, the big question is always, how long will it continue? And that is obviously, it will continue till you have 20% equity based on the original price. So, if you're paying the loan down over time, it's going to reach the point where your loan is at 20% equity level, or the loan's at 80%. If you look at it the other way, the loan is 80% of what the value of the property was based on the original price. It will automatically stop when you get to 78% of the original price, and that's usually in about 7 years. You can also ask the lender if they would accept a new appraisal be done to establish a new value, and that is sometimes allowed. And what would happen there is if you felt your neighborhood has increased in value, or perhaps you've done some work to the property, you could ask for a new appraisal be done, and then we can look at that. We obviously will look at your payment records. You can't have any late payments, and very often that is an option or a way to get rid of the mortgage insurance as well. So mortgage insurance, yes, it is a bit of another expense. It's not terribly expensive to get. The past few years, we've seen the cost of this go down very nicely. So if you're buying, and have good credit, that credit score becomes very, very important with this mortgage insurance, because they look at those credit scores very strongly. So again, good credit, not a bad cost, and it lets you get into the property much faster than having to save up a full 20%. So that's what PMI, or private mortgage insurance, is. Escrow accounts, I touched on most of this already. The last bullet down at the bottom here is the PMI and the escrow flood insurance. I'll talk about in a second. The PMI is always collected on a monthly basis, and that's not, you don't have to pay a year up front. It's just collected right from the start and going forward. Flood insurance is required on loans if you live in a flood zone. And we determine this through one of the closing costs. We get what's known as a flood certificate. So if you're buying a house that's next to a pond or a river, lake or swamp even, or the ocean, you may need flood insurance depending on what they call elevation, which is, how high the house is in comparison to the water or the flood water. They look at maps, how historically high the water has come and so forth. But this would be a question that or disclosure that the seller of the property or the real estate broker should answer right away, or disclose to you right away that the house, is in a flood zone and flood insurance is needed. The cost of it is probably about the same as homeowners insurance, unless you're in a very strong situation. I've got a couple loans that are right on the ocean. And they seem to be paying a little more for their flood insurance than somebody who lives by a seasonal brook or something of that sort. So that's that on that. All right, so there, I said fixed rates, adjustable rate mortgage loans. Fixed rates right now are super low. You know, you can buy 30-year fixed rates, you know, really still under 3%. We're seeing like 2.875 on a lot of loans. They're great. They're stable rates. The rates are never going to change. The adjustable rates on the other side, at this time, I can't even recommend them because most of the adjustable rates are higher than the fixed rate loans are. It's an odd thing. They're usually lower. And it says that right on your screen, as you can see. And just so you know how they work, a typical adjustable rate loan, it might be, you'll hear the terms 5-year adjustable, 7-year adjustable, something like that. That means that the loan would be fixed for the first 5 years or the first 7 years, and then would adjust every year thereafter, up or down. Worst case, it could go up 2%. Best case, it could go down 2%. And it would be fixed for that, you know, next 1 year period. So they're nice loans when the rates are low on the adjustable side, and you know you're going to be in and out of that property in a short period of time. So if you were, you know, if you bought, say, a small condominium and the adjustable rates were attractive, you say, well, this is a nice place, but it's a little small. I don't think I'll live here more than 3 or 4 years. That's when a 5-year adjustable might be a good deal. But as I say, in today's market, I would strongly suggest looking at the fixed rates because that's really what's best for you. All right, just to clarify a few things, and as I say, we're going to shoot through these things, some terminology, rates, points, and APRs. We touched about points earlier, but the rate, you'll see, you know, ads sometimes the rate will say, oh, here's our mortgage deal. It's at 3%, 0 points, and it will have an APR or annual percentage rate. And that annual percentage rate might be something like 3.012 or some such number like that. What are those things? First, the rate is the number, 3%. That's where we use to calculate your mortgage payment. All right. Points we talked about, 1% of the loan amount, you pay them at the closing, you get a lower interest rate. Annual percentage rate, this is where the confusion comes in. Because you see these two numbers on the rate boards or the ads. You'll say, okay, why do I have two rates? Top one, the rate, is always, the first one is always used to calculate. The second one is for comparison. It combines your rate, your points, and some of the costs involved into a single number. What they say, what if not only the rate, but if the points and the costs were also interest? How would that affect the interest rate? All right, so if you go down the street and stop into 3 or 4 banks, you can ask, what's your rate? What's the APR? It's going to allow you to compare loan programs quickly. And again, you have to compare, you know, 30-year loans to 30-year loans, 15-year loans to 15-year loans, etc. It's kind of like going into the supermarket and you see on the shelf the unit pricing stickers. And those unit pricing stickers, I think we're all familiar with, and they tell you how much things cost per pound or per gallon, depending on what you're buying. So, you know, if you're buying orange juice, you know, you can look at the quart bottle and the half-gallon bottle, and it will give you the price per gallon, which isn't the price of either one of them, but it's a comparison. In the orange juice department, usually the half-gallon juice is cheaper than the quart because it's bigger and you don't have to pay for more packaging. It's just very similar to the unit pricing in the supermarket. It's just taking everything, combining it into one number so you can make a quick comparison. And that's what an APR is. Think supermarket, and you'll be all set. All right. During the process of the loan, once you apply, we issue a loan estimate. And based on the information we have at the time you apply, it's the initial estimate of the cost. It's pretty accurate, but it's based on the information that we know at that time. Sometimes we don't have all the complete information. For instance, we won't know exactly what you're paying for your homeowner's insurance yet. Sometimes we get the wrong tax information from the real estate agent on the property. So based on what we know, we give you this loan estimate. We say, this is your loan estimate. This is what we believe the cost of this loan will be. Now let's fast forward a few weeks and you're ready to close on the loan. So at least 3 days before the closing, we're going to send out a very similar form, but now it's going to be called the closing disclosure. And it's going to be based on actual information. We're going to have the exact tax figure right to the penny. We're going to know exactly what you're paying for your insurance. We're going to know exactly how many days of that prepaid interest you're going to have to pay. And this comes out to you, as I say, at least 3 days before the closing. And it's going to be, it will tell you rather how much money you need to bring to the closing. It becomes kind of like the permanent accounting record of the whole transaction. It will show on there the initial deposit you made when you made your offer on the property. You make another substantial down payment when you sign the purchase and sales agreement. That's all going to be on this closing disclosure. As I say, it's a great thing to keep, and you keep it pretty much till you sell the house because it will show exactly what your costs were with that. So I put a line in there. All the documents should be submitted at least 10 days prior to closing. That just is referring to anything that we ask from you. We would like to get at least 10 days prior to the closing so that we can get this prepared and out to you and checked for accuracy and so forth. So that's those two things. Pre-approvals, a lot of you are probably thinking, maybe I want to get pre-approved for a mortgage loan. And there's a couple different levels, I like to say. There's an inquiry where after talking about this, and we talked about the income ratios early on, the 33 and the 43%. Those, you could call one of us tomorrow and say, gee, I was in the seminar last night and just trying to figure out how much money I can borrow. So we'd ask you some very simple questions. We'd ask you, what's your gross income? How much money do you have saved up for down payment? And what are your monthly debts? And based on that, we can make a quick calculation, unverified, of course, on roughly how much you can afford for a property. All right. And if you like that number, maybe you go on to the next step, the pre-qualification. This is where you can actually apply to us. You can do that online on our website. It's based on verified information because we will ask you for things like last year's W-2 forms, maybe a recent pay stub, bank statements to back up your down payment. And we issue this pre-qualification letter, which, the formal letter that says, we've examined your situation, we've obtained a credit report, and based on what we have found, we believe you're qualified for a loan of, X number of dollars. And this would really enhance your offer to purchase. The real estate agents are kind of looking for this type of letter all the time when they make an offer, and that's it. The difference between a pre-qualification and a pre-approval is really very little. The pre-approval, you must have an accepted offer on a property. So sometimes I'll have somebody, we do the pre-qualification, they go and they make an offer on a house, and the real estate agents are saying, well, this just says pre-qualification. Can you get a pre-approval letter? And yes, you can. You just send us the accepted offer and we can issue a new letter. And of course, to do all this, you can apply on our website, which is right there. And again, this whole package is going out to you, so you don't need to be scribbling down websites and whatnot. So that's that. Things to remember to make your life easy and make your loan officer's life easy coming down the road is to, one, consolidate money into maybe one or two accounts. If you have 50 different savings accounts, all with small balances, it's time to start moving them into one. Because we do ask for copies of statements for the last month on your bank accounts. And the fewer accounts you have, the easier it's going to be, easier for us to track the funds. And as I mentioned earlier, large deposits must be documented. If we see a deposit more than 50% of your gross monthly income, we are going to ask about it, where it came from, and so forth. So one of the things we look for that we don't like is cash. If you have cash in a shoebox and you are going to take that cash and put it in the bank, do it sooner than later, because if we see it in the month before you apply, we're going to question it. You're going to tell us it's cash, and we're going to say that's not allowable, not an allowable source of funds. So do that. If you sell something, again, detailed records, photocopies, et cetera, et cetera. We love paper. We love paperwork. And the more stuff that you can keep and give to us, the better. Yeah. So that being said, where do you start in this process? I strongly encourage you to work with experienced people, right through the real estate agents. Find somebody that you're comfortable with. How do you find that person? Well, maybe it's a friend or somebody your friends worked with or family has worked with. Go to some open houses on a Sunday afternoon. There is always a real estate agent in the open house. It might be somebody that you hit it off with and you like, and you can explain to them type of property and neighborhoods that you're interested in, and they may have some way to help you out with that. They're very helpful. They would love to sell you a house because that's how they get paid. But again, you want to be very comfortable with whoever you work with. Inspectors, kind of same thing. Get referrals. Make sure they're licensed. Talk to your friends who have recently bought. This is an important thing. This is the guy who's going to look at your house, check the plumbing, the electric, the roof, the windows, etc. You want somebody that is knowledgeable. I've seen inspectors just go in with a little check sheet, and check off. Yes, the house has got a roof, it's got plumbing. You want somebody to give you maybe a little more information than that. Is the plumbing good shape, bad shape? Is the heating system newer, older? Does it look like it's, going to fail in another year or two? How's the roof look? Is the roof, new or old? All that kind of stuff. A little narrative next to the check marks is always good. Attorneys, you want somebody who really specializes in real estate transactions and locally. So, if you've got a friend that practices real estate law, even, what you think is local in Worcester or Springfield, that is not local. If you're buying in Medford, you want maybe somebody who's in Medford, or at least does a lot of work in Medford. So that, would include, local towns, maybe Malden or Somerville or something, because a lot of real estate is local and local laws and local ordinances. So somebody who does that, and we can help you in that. We've got a big list of attorneys, and we could refer you to, we usually give 3 or 4 names that you could talk to them. And of course, the lender. You want to work with a lender, again, that you're comfortable with, and that's why we're here tonight. We hope we've helped you out a bit tonight. And like I say, myself, Joe, Chris, and Tricia, I'm more than happy to help you out. But, we're all very experienced. I've been doing this now about 35 years. And I think Chris has got a lot of years in. Joe's got more than me. And Tricia's about the same as me. So we're good. So that pretty much finishes up the actual presentation. Couple things. We're going to open it up to question and answers, or if there's any questions in the chat box, Leo will help us with those. One thing I do want to mention is that as attending tonight, we will be issuing to you all a $1,000 credit if you buy a house in our community reinvestment area. And that's a group of 15 towns, all surrounding Cambridge. It's basically the towns where we have branch offices and the towns that touch those towns. So it's a lot of towns. So to qualify, you've been here listening to me, so that gets you in. But you have to buy a house within the next 12 months. So by next October 1st, or apply by next October 1st, I guess, for that loan, and we'll honor that. And I thank you all for listening to me, and let's open it up for questions. And Chris and Joe, jump in. Tricia, if you're there, jump in and
Yep,
help
I'm
us
here.
out.
Thank you,
Tim,
Tim.
thank you so much. Also, there were two other bank employees joining us who I did not introduce at the beginning. Laura Berg, who is our one of our community outreach officers. She promotes a lot of these first-time homebuyer classes in our communities, and also Michael O'Donnell, who is also a residential loan officer with the bank. They are also here tonight.